As we head towards the opening bell on November 10, 2025, Datavault AI, trading under the ticker DVLT, is already setting the market on fire. In pre-market trading, the stock is indicating a massive jump, sitting at $2.01 per share. That is a staggering 18.93% gain from its previous close of $1.69. For any trader who has been watching this name, that kind of pre-market momentum immediately screams that something significant has happened. The immediate expectation for many seeing this pop is that it must be another AI-driven contract, a new patent, or perhaps retail traders piling in for another squeeze. But the reality of what's driving today's action is far more complex and cuts right to the heart of a vicious battle that has defined this stock for weeks. The reason for this surge is not a new client, it is an act of war. Datavault AI announced just hours ago that it has officially filed a lawsuit against the short-selling firm Wolfpack Research and its founder, Dan David. This lawsuit is in direct response to a short report Wolfpack published back on October 31st, which, as you would expect, sent the stock tumbling. In its complaint, Datavault claims the report was filled with false and misleading accusations and defamatory statements, and that the defendants showed a clear disregard for Datavault's public filings, ignorance of verifiable facts, and blatant omission of critical context. This is the core of the expectation versus reality narrative for DVLT right now. The market has been trying to figure out if Datavault AI is a groundbreaking technology platform or, as the short sellers allege, a house of cards. Today, the company is fighting back, not with a press release, but with a legal filing. This pre-market jump is the market's initial reaction, betting that the company's aggressive countermove holds merit and could force shorts to cover their positions. Let's establish the common ground here because if you've been in this trade, you have experienced whiplash. The general belief and what the bull case rests on is that DVLT is a deeply undervalued microcap stock on the verge of explosive growth. You have seen the headlines. A major $10 million exclusive licensing agreement with Silex Holding Company, a strategic partnership with IBM that makes them a platinum partner, and guidance from their last earnings call targeting a $25 million revenue run rate by the end of this year and a $40 to $50 million target for 2026. This is the story of a company that, after pivoting from its former life as Wyza Technologies, is successfully commercializing a portfolio of patents in AI, data monetization, and Web 3.0. But the reality that traders have had to stomach is brutal volatility. Even with the stock up over 350% in the last 90 days, it has been absolutely crushed in the short term, falling over 40% in just the last week of trading, largely thanks to the pressure from that Wolfpack report. This brings us to the critical issue that all investors in this name must understand, the short seller campaign. This isn't just background noise, it is the entire story right now. When a firm like Wolfpack Research issues a report, its goal is to convince the market that the stock's price is not real and to profit from its decline. They are betting against the company. The lawsuit from DVLT is a direct challenge to that thesis. This is where retail investors often get caught in the crossfire. On forums like Reddit, you can see the debate raging in real time. There are threads dedicated to a high-potential short squeeze, citing the new lawsuit as the catalyst that will force shorts to buy back their shares at a loss. On the other side of that same discussion, you have skeptical investors pointing directly to the Wolfpack report's claims, with some saying they feel the company is built on scams and questioning the validity of its announced partnerships. So what should an investor do? This is where you have to ignore the noise and look at the data. Let's get actionable. First, where to find the short interest data. You can check platforms like FinViz, Fintel, or your broker. As of the last reporting period, the short interest in DVLT was significant. Fintel, for example, reported 9.72 million shares held short at a borrow rate of 10.71%. That borrow rate is the fee short sellers must pay to borrow the shares to sell. A rate of 10% is high and indicates a strong demand to bet against the stock. If we see this rate spike in the coming days, it means the battle is intensifying. The second thing to watch is the days to cover, which was recently reported at a very low 0.23. This metric suggests that based on average volume, shorts could exit their positions very quickly. However, that data is from before today's lawsuit. A buying frenzy ignited by this news could trap those short positions, creating the squeeze that many are hoping for. Do you believe the Wolfpack Research report was a valid warning, or is this lawsuit from Datavault a sign that the short thesis is collapsing? I want to see your take on this in the comments.
Recognizing a coordinated short attack versus legitimate research is difficult. The lawsuit alleges this was a malicious attack. Investors should look at the source of the short report, see if its claims are verifiable against the company's public SEC filings, and most importantly, watch how the company responds. A vague, dismissive press release is one thing. Filing a lawsuit in federal court is a much more aggressive and confident response. The risk for retail investors is chasing a squeeze. These moves are violent and can reverse in an instant. A responsible approach is to understand the fundamental bull and bear case separate from the squeeze narrative. So, what is that fundamental case? What does Datavault AI actually do? The company describes itself as a leader in the visualization, valuation, and monetization of assets in the Web 3.0 environment. In simple terms, they're using artificial intelligence and blockchain technology to take data, which is often messy and siloed, and turn it into a secure, verifiable, and tradable asset. Their patented technologies like data value and data score are designed to appraise and validate everything from intellectual property and financial data to name, image, and likeness rights for athletes. This is the picks and shovels play on the new data economy. They're not just a concept. They have been signing deals. They're integrating their tech with Wellgistics Health for a blockchain-based pharmacy tracking platform. They just announced a deal with Rodney's Comedy Club to create a laugh index and copyright jokes in real time. This illustrates the breadth of their platform's potential applications, from high finance to healthcare to live entertainment. Financially, the company is in a high-growth, high-risk phase. When they reported Q2 results back in August, they showed a revenue of $1.7 million. While that sounds small, it was a 467% increase from the same quarter last year, and it beat revenue estimates. The company is, however, deeply unprofitable, posting a normalized loss of 65 cents per share in that same quarter. This is the classic microcap growth story. You are betting that the massive revenue growth will eventually outpace the heavy spending and lead to profitability. The bear case, as outlined by Wolfpack and debated online, is that this revenue is not sustainable, that the partnerships are not with major players, and that the company's valuation, which at one point had a price-to-book ratio of 6.9x versus a peer average of 4.6x, has gotten way ahead of its fundamentals. This brings us to the future outlook. The expectation is that this is just another volatile AI stock. The reality is that investors are facing a convergence of several massive binary event catalysts that could send this stock to double digits or back below $1. The first and most immediate catalyst is the upcoming earnings report, which is expected around November 14th. This will be the company's first chance since the Wolfpack report to publicly defend its numbers and, more importantly, update its guidance. If they meet or beat that $25 million run rate projection, it would be a huge blow to the short thesis. The second catalyst is, of course, this lawsuit. Legal battles are long and messy, but any positive rulings or even a retraction from Wolfpack would be explosive. But there is even a bigger, longer-term catalyst that many have missed. In their last earnings update, Datavault's management talked about the Genius Act being signed into law. They stated that third-party legal counsel has identified top U.S. banks as patent infringers on Datavault's Web 3.0 and data exchange patents. The company has retained a top-tier IP litigation firm to pursue licensing settlements or, if necessary, initiate litigation. This is a high-stakes, high-reward strategy. If they can successfully enforce their patents against even one major bank, the licensing revenue could be transformative, completely rewriting the company's financial future. What's your take on Datavault's aggressive patent strategy? Do you think they can win against major banks? Let me know in the comments below. So, as we watch DVLT surge in the pre-market, it is crucial to understand what is at play. The common expectation is to see a small-cap AI stock running. The reality is that this is a company engaged in a two-front war, a public and legal battle against a prominent short seller and a high-stakes patent enforcement strategy against some of the largest financial institutions in the world. The volatility you are seeing is a direct reflection of this conflict. The stock is reacting to the lawsuit news today, but the next major signal to watch will be that earnings report in the coming days. The risk is extreme, but the catalysts are undeniable. This is no longer just a trade on a chart. It is a bet on whether the company's patents and its legal team are as strong as their management claims.